US dollar to Japanese yen intraday trading, institutional perspective. US dollar to Japanese yen is one of the most structurally driven currency pairs in the market. Unlike pairs that react mainly to economic news, US dollar to Japanese yen is fundamentally driven by interest rate differentials, especially US Treasury yields versus Japanese yields. At the core of US dollar to Japanese yen movement is the US 10-year Treasury yield. When US yields rise relative to Japan, capital naturally flows out of the yen and into the dollar, pushing US dollar to Japanese yen higher. This correlation is mechanical, not emotional. That's why professional traders monitor yields before even looking at price charts. Technical patterns help with timing, but yields provide the real direction. Intraday, US dollar to Japanese yen follows very predictable liquidity windows. The Tokyo session defines the daily range, known as the Asian box. This period is typically accumulation, driven by Japanese exporters and importers, especially around the Tokyo fix. The real volatility usually begins at the London Open, where price often makes a false breakout to trap traders before reversing or trending. One of the highest probability setups comes from this behavior. If price breaks the Asian range at London Open and quickly fails, it often reverses toward the opposite side of the range. If the breakout is strong and supported by rising yields, the move tends to continue. To refine entries, professional traders use mean reversion and volatility tools. The 2-period RSI identifies extreme short-term overextensions caused by algorithms. When used in the direction of the dominant trend, it captures fast snapback moves with high probability. Institutional traders also focus on liquidity and imbalance, not indicators. One powerful structure is the fair value gap. Markets frequently return to these zones to rebalance, offering precise, high-quality entries, especially when aligned with macro drivers like yield surges. Finally, risk management is non-negotiable. Stops should adapt to volatility using ATR, and no single trade should risk more than 1% of total capital. In Forex, survival is the edge.